Hello, good afternoon, and welcome to today's webinar. My name's Simon Smith, and I'm Head of Research here and Chief Economist at FxPro. So I do these webinars once every 2 weeks. I think the last one was a month ago because I've been on holiday. Really looking at moves on the markets and what are the big themes for currency markets, what's driving things. So it's less technical, a bit more fundamental, let's say. And then looking at what the risks are and why markets perhaps trending, consolidating, etc. I use quite a few charts, so generally I download them from Bloomberg. They might not be the best quality, but I'll try and walk my way through them and explain them so that they tell a particular story. Before I move on, just want to make you aware of the disclaimer, which essentially says this should not be seen as investment advice, so I'm not telling you whether to buy or sell securities, and also the risk warning, which essentially says that we're not a broker, and basically says you should seek independent advice where necessary before deciding to trade. You can find more details on that at our website as well. Let's just run through what I want to talk about today, which is really taking a look at the broader market environment. Lots of interesting things going on, not only in FX, but also some of the trends we're seeing in equities and bond markets, also credit as well. So let's have a look at that because it's all relevant for FX and the environment we find ourselves in. Taking a look at the dollar, which was naturally quite firm during July. A lot of reasons for that. I think we're up about 2% on the dollar index. And also sterling. So we've taken another beating on sterling, but I think there's some scope for recovery once the dust settles down. The Aussie, I think, could be a bit vulnerable this week. We've got a couple of events which could be pushing it lower. The euro, also talking about why that, I think that's still going to be relatively well supported. Yes, euro dollar's moved lower, but perhaps not as low as many people think. So on that basis, we should keep a watch out of that. Looking at some charts and also finally going through some summary and questions. Okay, just answering a question here. As I said, if you do have, actually I've lost my chart there, but if you do have a question, you should see a little sort of drop down menu at the top of your screen, and from there you can post something in the Q&A panel. What I generally do is try and keep the questions to the topic during the event, but naturally towards the end, generally I talk for about 25 minutes, leaving 5 minutes for questions at the end. So if you have any broader questions, you can ask them. So I'm just asking about sound, so glad they've got all the sound things sorted, so that's good. Let's crack on. So as I said, this is a sort of dollar index. We've been up 2% in July. This has come really after the first half of the year where pretty much the dollar was just about unchanged. Remember, this is a year in which nearly everyone was dollar bullish in some way, shape or form, and the Fed tapering expectations gathered pace. So it's notable we've seen a more cautious August so far versus what we've seen. Someone else saying about sound, so the sound is generally fine. If you can't hear, let me know. So, okay, so just bear with me. Done. The VIX is interesting. What's seen? So both these measures you see on the screen measure volatility. So the white is the VIX. People talk about that. What it essentially does for equities is take the prices of various options, which are really predicting the amount of expected volatility in the future. So you can measure past volatility, how volatile something is, but there's also embedded with options is how volatile the markets expect something to be in the future. If there was no volatility, then options would have no value because options give you the right to buy or sell at a certain price in the future. So if it's not going to move, it'll never reach that price. You can see the push up we saw in equities on the white. You can see that we've virtually come back there. But the interesting thing, FX market volatility in the orange didn't increase as much, but has actually sustained that increase. And the bottom shows a correlation between the two. So we've seen a sort of a bit of a general more volatile correlation between what's going on in equities and what's going on in FX as well. So FX volatility, which has been at multi-year lows, this is a Deutsche Bank measure I look at, has actually been increasing. So that's sort of promising, at least in terms of trading opportunities, and probably will, I think, be sustained. So here's a few other charts. So I apologise if you can't read the scales, but I'm just going to walk through them. One of the most remarkable thing about equities is two things. Number one, this is a monthly chart going back to 2010 for the S&P 500. So two things that strike out here is, number one is the fact there are very few blue candles, so down months. We've only seen July, January. So only 5 of the past 24 months have been down months for equities, and looking at the S&P. So that's pretty remarkable. Also, in terms of corrective activity, there are some stats floating around in terms of correction, i.e., 5% correction. We've gone the longest period for if many years, if not decades. So I guess the second thing to note is the extent to which we've not seen any real notable corrective activity in equities. And whilst people have been pointing that out for nearly a year now, more if not more, nevertheless, markets continued higher. The interesting thing, I think, is what's happening to bond yields. We've seen this again in the US. I've picked out Germany here just for two reasons. Germany has moved below 1%, so the German 10-year bond, so the price it costs Germany to borrow money for 10 years as a government, is now below 1%. So where we this time last year, we're about 1.5%. We were up at 3.5% back in 2011. You can see a real bit like with what we saw in equities going the other way. So we've seen this really strong sustained period in which bonds have rallied virtually continuously. Again, you've seen it's only 6 past 24 months when we've seen corrective activity, so bonds rising as in price or falling in terms of yields. So basically, bond investors and equity investors have done well over this period, which doesn't, there's no sustained correlation, but is more rather than the exception than the rule. Bond yields in general, again, it's a generalization. Your falling bond yields usually a sign of sort of a slowing economy, etc. A time when you'd expect equities also not to do that well. But the 2-year, so the price of, or the yield that it costs Germany to borrow money is also below 0%. We saw that in sort of 2013, 2000. We've seen periods of that again, just because the ECB has been putting so much money into the market, what's called excess liquidity. Banks have just sometimes just needed to park that in high quality paper, and it's less worried about the return, more about the fact where it is, and that it's in bonds of a certain investment grade or AAA. So on that basis, we have seen these periods, less liquidity floating around. So this is perhaps less liquidity driven as it was here, more fears of deflation, let's say, which certainly wasn't the case in 2012. So we've got here again, I think this time for different reasons, and it's, again, you'll see the significance a bit later. So you get these funny, well, not funny, but Spain anomalies, let's say, or that, again, an anomaly in the pricing is judgment of the market, really. But nevertheless, Spain can borrow money for 10 years at pretty much the same price, in other words, yield, as the US. And 1 year ago, Spanish yields are 1.5%, 1.6% above the US. So you've seen a huge rally that's now allowing, and many will say, well, this doesn't make sense. Look at the US, credit rating, economy, liquidity, dollar, etc. Why is it that Spain can borrow money the same as the US? So this may not be totally apparent now why it matters, but a lot of these things can be a sort of sign of worse things to come, or an alarm bell, let's say. German borrowing costs are just, 0.5% above Japan. We were 1.2% at the start of the year, so we've seen Germany, let's say, looking more like Japan in some ways. And we've also seen Italian yields, which early June were equaling the UK, and now just 0.25% above. So, talk about bubble conditions. Are we in bubble territory in a lot of these situations, or is it just that Europe is priced for recession and deflation? You can cut it both ways, but it's a debate, and I think it's worth keeping an eye on, just because quite often low volatility mispricings of this, or perceived mispricings of this sort, can often come before, let's say, something worse. So let's look at some currencies. The dollar, stronger than expected data certainly helps. The white line measures data surprises going from January this year to now. So if data's coming in stronger than expected, inflation surveys, labour market data, you see this white line move up, weaker than expected moving down, and the orange is the dollar index. You can see generally a positive correlation, but certainly not a sustained positive correlation. So it's not just stronger data that's driving the dollar, but it was the case in the latter half of July, and so you can see in a way it looked like this sort of data was playing catch up with the dollar, but it's probably not the case. But nevertheless, you can see we've seen data come off now. So data, talking about the level of this line, it's just a direction that can be of interest. So data has actually been coming weaker than expected, but the dollar has held up relatively well so far. But perhaps if we do see this continue, there's a bit of a warning sign that the dollar could lower. But what it does mean is that at the moment, at least, that sustained dollar strength is being elusive. And if you consider back to the pre-crisis period, quite often you saw periods where the dollar was when it was falling, I think in the early part, would fall sort of 3/4 of the time. And so you'd see 75% of down months in the early part. So, and again, it's markets a lot less trended now, so you're seeing a lot of less in terms of trends. So I think it's worth noting that. Sterling again, but having said that we're less trended, we've seen a hugely strong trend in sterling the past 6 weeks. You have to go back to late April to early June on cable to see a similar period. That's this period here, when we saw six weeks of consecutive falls on cable. This is a much sharper fall. So we've fallen about 2% here. This was about 4 or 5%. I was looking at this on Friday with someone else. So we have seen a pretty unprecedented move in sterling. The early part was driven by the stronger dollar. The more latter part has been driven by a weakness in sterling, not only against the dollar but in others. And again, we've had the central bank governor Carney changing his mind. Some perceive on terms of the drivers of inflation, and now looking sort of less on forward guidance. This desire of a central bank to try and guide markets on what might happen to interest rates, which has proved unsuccessful for the bank, because they were saying interest rates would rise if unemployment fell to 7%. It happened very quickly, then changed that into other measures. So bottom line, people are still getting the impression that the Bank of England is sort of going hot and cold, and we had a bit of a reversal on sterling this morning after a weekend interview when he sort of seemed to downplay some of the things that he'd been saying at the inflation report last week. Keep your eyes out here, because we have minutes from the meeting on Wednesday, so that will be important. I guess a small risk of someone voting for higher rates. I'll see it sort of a low probability but high impact event there for Wednesday. The Aussie, I think, is also to be interesting. 2 reasons. We got the minutes to the RBA meeting released overnight tonight. They've sort of been changing their tune a bit. That would be, we had some labour market data. We saw a sharp jump in the rate to 6.4% from 6%. So we've seen a sort of weakening in the domestic data. So I think the minutes may not be reflective of that. I think it came out after the meeting, but I can't exactly remember because I was away at the time. But let me just check my calendar. But also the other thing is that no, it's 2 days after the meeting, so I'd imagine they would have had that data in their hand. Generally, central banks would get at least some pre-release on the data. So we could see that reflected in the minutes. More interesting could be this: Stevens, central bank governor. He speaks on Wednesday, and he was quite notable in the currency. And I can't see it on this chart is January to now. So in December, he was notably talking down the currency, and then he changed his tone here, just near the lows, and which is one of the reasons why we saw the Aussie doing well. But they're clearly seeing a slowing economy now. Bit of an impact on labour. China has not really been an impact. So they've managed to weather the slowdown in China, but that still is something in the background. So worth, I think, watching. And I think the Aussie could be a bit more vulnerable this week for those two reasons, especially perhaps more on Wednesday. Let's look at the euro, and interesting chart I've saw today. This looks at inflation expectations. So what's important for a central bank is not only where inflation is now, even though it's low, is what's happening to expectations. And there's lots of ways of measuring expectations. You can naturally ask people in the street, you can ask businesses, you can ask households, you can derive inflation expectations from market securities, inflation-linked bonds, which have embedded within them a view of inflation during the period, inflation swaps as well, similar to bonds. So within that is an expectation of inflation, so derived from buying and selling in the market. So bottom line here is 2, 5 and 10, 2 green, 5 red, 10 black. So you can see the sort of pretty sharp fall we've seen, and even the last couple of months, couple of weeks, pretty sharp fall as the inflation data has come in weaker than expected. So the ECB has a target of 2%, so you can see generally pre-crisis around 2%, a bit higher, even post-crisis staying at 2%. They've seen a big fall from 2% mid-2013 down to about just below 1.5% now on the 10-year inflation. So you can see expectations are changing. Investors are seeing not only short-term but longer-term inflation coming in lower than expected within the Eurozone. So that in itself is quite notable. You also see there's some measure inflation on the yellow of the periphery, so Italy, Greece, Spain, and Portugal, Ireland. You can just weight their inflation rates by their sort of shares of output. So I've done that to create the sort of Eurozone inflation rate. And you can see here the extent to which inflation in those countries is below Eurozone inflation itself, but pretty much the whole period ahead before the crisis, the opposite was true. Was in these countries are outperforming, and costs are increasing, wages are increasing. You saw inflation generally run ahead. One of the reasons why they have problems now in terms of competitiveness, etc. So this trend is quite worrying. 0.4% is worrying overall. So the fact we're seeing this in the Eurozone is in itself quite pertinent. But perhaps seeing the euro fall as much as you would maybe need to think, given what we're seeing in inflation. Yes, euro dollar has fallen naturally, but if you take the last couple of months, certainly the euro has not fallen out a bit. You've seen some of Scandi currencies, Swedish krona, Kiwi, and even sterling sort of, pretty much sterling's kept pace just about with the euro declines. The sort of dollar block, let's say, is New Zealand and Norway is uninformed. So actually, yes, the euro's been weak, but given what we've seen, it's not fallen out of bed. I think the underlying reason for that is the fact that the interest rates are near to zero. Even if the ECB did QE, and there's this ongoing debate about buying mortgage-backed, asset-backed securities, and or even if they could, let's say, buy government bonds, what difference would it make? As I've showed you, the yields on those government bonds are already very low, and by buying government bonds, a central bank wants to push yields even lower. That helps lower borrowing costs for businesses and households, and by that, it helps the overall economy. So actually, even buying bonds, even if they could, very difficult because of the way the ECB is structured. That probably wouldn't have a massive impact on the currency. So actually betting on or looking for a lower euro because of deflation is actually difficult. And I say see Japan and making the point that actually You know, a lot of people have looked at Japan and seen, you know, the, what's going on there and thought the yen would weaken. Nearly always the yen has strengthened, leaving aside the sort of moves we've seen end 2030, early 2014, which are more policy based, but the whole history of the yen has been for strength despite what's going on. And so, you know, you're perhaps going to see more of these parallels between what's going on in Europe and what we've seen in the past in Japan. So making that point, and I think it's one that has been relevant for the euro for quite a lot of the recent history. So keep that in mind. Don't just think, oh, the euro, you know, the ECB can do more, so that means the euro is going to weaken. A few others charts look interesting. Just very briefly, again, I've badly labelled these because I can't increase the font size, but this is from January to August. This is Aussie yen from 96 down to the low just above 88. Seen pretty strong resistance around that 96 and a half level, and you know, I think we've seen a decent volatility here. But I think this is, you know, when we do see the Aussie turnaround, this could be one of the opportunities, because if we fail to break that 96 level, it's certainly indicative of a sort of quite decent pullback on Aussie yen. So worth keeping that one in mind, especially this week, given what we're anticipating on the Aussie itself. Gold is pretty range bound, really. If you look at the moving averages, sort of, I have sort of 50, 100 days, so you know, we're pretty much sticking and really the midpoint of the year. So despite all the volatility we're seeing, or you know, in terms of geopolitical risk, let's say, gold has been pretty steady. So it's, you know, can't get excited either way at the moment. I was pretty bearish on gold the last 2 to 3 years. So I still think the 1200 level, 12, probably even 1250 should hold. But actually, you know, we need to sort of break out one way or the other to make it a bit more exciting. But you know, as a let's say a hedge asset, it's not performing in the same way as certainly been the case in recent past. I think euro yen. I mean, I haven't not even showed dollar yen because dollar yen is pretty boring chart to say the least, and especially given the sort of moves that we were seeing, you know, 18 months ago, late 12, early 13. So compared to that, dollar yen is a bit of a snooze. But euro yen, as you see, starting to see that recovery. So that's forming a base above 136 again after what has been a sort of pretty sustained period of weakness. Perhaps just keeping an eye on that. Again, just on the basis that I don't see the euro necessarily weakening substantially, given that the limited options for the ECB. So, yeah, perhaps a way just to sort of play, if you want to sort of play the euro to the upside, maybe better than sort of looking at euro dollar at this point in time, just given the risks that we see from the US data side and the scope for further dollar gains. So just to summarise, we're going for 23 minutes now, so I always aim for 25 and 5 minutes of questions. Remember, stuff this week, so it's, you know, dollars, we have the FOMC minutes Wednesday. I wouldn't see sort of great risk from those. Central bankers meeting at the end of the week in Jackson Hole, which is like a sort of out of town, let's say, more sort of blue skies thinking type event. So it can be a note for markets, just a lot of people are speaking, but they're usually looking at the sort of bigger picture and not trying to, let's say, comment on sort of day-to-day events. But nevertheless, worth keeping an eye on. Late Thursday, I think they start gathering, so maybe Friday in the weekend. Sterling, we have inflation data tomorrow, expected to come back from the strong 1.9% reading, so just keep an eye on that. But I think the minutes Wednesday, the sort of low risk, low probability but high impact event, if it does happen, if you see someone, at least one member, vote for higher rates. So the Aussie, I think, could be a bit vulnerable this week as well. We have RBA minutes Tuesday and the central bank head speaking Wednesday, and you know, that's his semi-annual testimony. So the point, or if he did want to sort of steer things on the Aussie, as he has done in the past, and we're quite a way higher than he was doing when the last time he was trying to talk down the currency. So it's just something to keep an eye on in the background. And finally, just on the Eurozone, as I said, I sort of painted the sort of bigger picture on the euro in terms of what's driving that. But shorter term, we have PMI data towards the end of the week, and that's naturally significant, giving a sense of the sort of momentum in the underlying economy for sort of going into September. So just worth keeping an eye on those, just because there are expectations for sort of both manufacturing and services to fall. The manufacturing release is still both are sort of holding above that 50 level, but given the fears of sort of slowdown and the flat GDP numbers we saw last week, I think they're going to be more in focus than usual. If you want to see the list of future webinars, you can go search FxPro webinars. Should take you to the webinar page. I think I'm doing the next one next Tuesday, which is looking at sort of I think it's sort of the Forex basics from memory. Get the page up, you will see the upcoming webinars. Introduction to Forex trading is Tuesday next week, something on Super Trader on Thursday, and another sort of outlook for FX fundamentals on Friday next week. So look at those, you can sign up, give us any feedback from the link at the end of the webinar. And that's great, thank you very much for your time.